Well, first of all, I think the public thinks that the silver market is basically the retail market, so they buy silver at their local dealer or through the web. You know, well-known notables like Miles Franklin as an example, and there's several. And that is definitely part of the silver market, but the real silver market is a derivatives market like all. So it's basically a huge amount of paper contracts that go ebb and flow up and down with a lot of professionals that are very good at, let's say, capturing small movements and making large money because it's so leveraged, and I don't think people really understand that part of the market or how it actually, and then on top of that, the real silver market not only being run by derivative, but the fact that 1,000-ounce commercial bars are the true silver. In other words, that's the price that's discovered by the contracts sold on the futures exchange. It's there in London, it's in New York, and of course there's the Shanghai Music Gold Exchange, the similar other smaller market, and so I think the misunderstanding can be that what drives the silver music market is perhaps the retail investor buying silver. Certainly that has an effect, but the real effect is the commercial bar market. Music, and we're in a position now that is what's new, is that demand for commercial bars music exceeds the supply. Is it momentarily, or is it from now on? I do not know. What I do music know is momentarily, meaning the past few months there's been a mismatch between the amount of physical silver available at the right location at the right time, and this has produced discrepancies in price discovery, meaning that there's an arbitrage opportunity. The arbitrage means it's a given commodity or stock or house or whatever that's identical or fungible, and it has a different price in a different area, and so you take the product to the new area and get a higher price for it. That's an arbitrage, and that's been happening in silver a few times here lately, which is rare to take place, especially music this off, and we're seeing that reconciled, perhaps momentarily, music, what's taken place here recently. I think the bottom line, to summarize it, Michelle, would be the demand for industrial silver. The 1,000-ounce bars is at a level that I have never seen before music, and it's causing, in my view, or one of the main causes, to see a significant rise in music, the silver. What is the data that corroborates that it isn't there? One is the arbitrage I just mentioned. That's a data point that you can point to as a fact. The other is less notable, but certainly there as a fact, that is that silver became a critical mineral recently for the United States. Critical really means strategic, and it was used basically for something that you have to have, especially in a strategic sense, meaning militarily. The strategic stockpile before it was turned into silver eagles and sent out to the U.S. Treasury to mint was 139 million ounces. So if we go back to that kind of a level over the next few years, that's a further demand on the silver pile that exists. That's music shrinking year over year. So that's one. The other one, India has become much more into the silver market. They always have been, but of late, they have been very, very large purchases of silver. In fact, they have a similar ETF to what we know as the SLV or PSLV, where it's physically backed by silver, and they cannot actually get the amount of physical they want at this time to back up new shares of their ETF. That can be pointed to as a fact. Another is Russia has bought into silver not necessarily from a monetary perspective, but from a strategic asset perspective. Music say that would be another one, and you can also look that the Saudis bought about 1 million shares of the SLV recently. And of course that sounds like a lot for you and I, but for them, I mean, 1 million shares is not very much. But nonetheless, it does show that there is a nation-state willing to take a stake in silver, and that is not a first, but it's a music first in this bull market. So these factors all are synergistic in a way. And lastly, I would say that clears throat the inability to have the silver get music to the right place at the right time. That's more of a logistics problem, but yet it seems to be occurring more and more. It's sort of like a shuffling the pea between the shells. Where is it? Who needs it? And where's it going to go? And that's probably a good analogy for where music I see the market. All markets move at the margin, as you know, and the margin for silver music is at the monetary, but the industrial demand has gone up very, very rapidly in the last 25 years, which sounds like music a lot, but in human terms, but in monetary terms, it's nothing. So if you go back 25 years ago, 35% of the market was industrial, and at that time we only mined 550. Today, industrial demand's probably pushing 70%, and we mine 850 million ounces. Music, so think about that. The amount of demand 25 years ago was U30 of 50, so maybe a couple music to 150 million ounces. Now 70% of 9, it's like 600 million, so that doesn't go away. Now in a big recession or a global contraction, it could mitigate it somewhat, but not that much. Now the calling card is the monetary, and that's where retail has backed off. I just checked again today with a couple of the big wholesalers, and they're still buying back more silver from retail than they're selling. But bigger institutions, as you outlined, Michelle, are buying silver for monetary purposes and thale music demand, I think is where I've talked about for you, which means when that point in time happen where industry and monetary demand come together at the same time, we are going to see an explosion in the silver, and it's basically more industrial right now, I'd say, than monetary, at least from music, the retail side, but both demands are there and accelerate, and this is something that in a very small market like silver, you could see these extreme moves, which you've seen the last 3 or 4 days where we go from, oh, it hit 54 and it comes right back down to the 50-day moving average, and then all of a sudden it goes past 54. Music, we're sitting near 60. And that's the most people who wander into the silver market think they understand it because they've bought music, a few coins, maybe a bar or two, and they've watched a couple of YouTube videos. And that's fine. Retail investment is absolutely music part of the ecosystem, but it is not the engine that drives the price. The real silver market doesn't live in coin shops or online dealer inventories. It lives in the derivatives market where 1,000 commercial bars dictate the music global price, and where leverage, liquidity, and professional trading behavior shape every tick on the screen. That's where the disconnect begins. The public still believes prices are made at the cash register when someone buys Eagles or Maples, but the reality is that the market is dominated by a handful of commercial participants, music trading claims on metal. Paper promises that move prices far more than physical buying ever could, and that misunderstanding music leads people to misread what's really happening right now, because what's happening is unprecedented. For the first time in decades, demand for commercial-grade silver, the bars that settle industrial contracts, refinery flows, and wholesale transactions, is exceeding supply. Not tight, music not strained, not elevated, exceeding. When you hit that point in a commodity market, you move from price fluctuation to structural music stress, and the evidence is showing up exactly where you would expect it to. In arbitrage anomalies, in premium distortions, in delivery delays, and in government declarations that are quietly shaping the next decade of silver pricing. Let's start with the arbitrage music, because that's the kind of thing that never happens in a healthy, well-supplied market. Arbitrage means the same asset is trading at significantly different prices in different regions, and traders can profit by moving the metal to where it's more valuable, but arbitrage should be tiny. Efficient markets eliminate it almost instantly, yet in the last few months, we've seen London to Shanghai price spreads wide enough to justify air freighting metal across continents, something that would normally destroy your margins. That doesn't happen unless the supply chain is so stressed that location becomes more important than price. Music, and remember, this is commercial silver. We're talking about the 1,000 bars that form the backbone of industrial demand, the solar industry, the electronic sector, chemical catalysts, medical applications, 5G networks, EV components, music battery systems. Industrial users don't buy Eagles, they buy commercial bars. Music, and the fact that these bars are being shuffled around the world like high-value chess pieces, tells us something fundamental about the state of supply. But arbitrage is only the first sign. The second sign, and I think this one is just as important, is the reclassification of silver in the United States music as a critical mineral. The public glossed right over this. They thought it was a bureaucratic footnote. It wasn't. The last time silver was treated as a strategic material in the U.S. was when the government held 139 million ounces in the strategic stockpile. That stockpile is now gone. Monetized into eagles and scattered across the retail market, reclassifying silver as critical is Washington's way of saying we need this metal for national security and we don't have enough of it. It is the kind of quiet policy shift that foreshadows future buying. Not from retail investors but from governments. The kind of buying that doesn't show up in dealer sales but shows up in warehouse depletion and refinery shortages. And that brings us to India, which has long been one of the world's major consumers of silver. But in the last year, their demand has transformed from large to extraordinary. India's silver imports surged so aggressively that their own physically backed ETF has been unable to acquire enough metal to music match demand for new shares. That's not theory, that's not rumor, that's not a blog post, that's a hard, verifiable structural constraint. When an ETF designed to hold physical metal cannot source metal fast enough to meet creation demand, the market has crossed into a new phase. Russia has also stepped into the silver market, music not for monetary reasons, but for strategic supply. And when nations begin accumulating a metal that has monetary history, industrial necessity, music, and geopolitical leverage, that is a signal most investors don't recognize until years later. It means silver is becoming a tool of statecraft, not just a commodity. We have been in a secular market since basically the year 2000 for gold and 2003 for silver, and we've gone from 252 gold to 400. It's backed off somewhat, but all markets move basically in 3 phases, up or 5 overall legs. There's an up phase, a down leg, an up phase, a down leg, and a final up leg. We're in the final up. I just had one of my clients ask me this very question. I explained to him that in the acceleration you will see, as the name implies, larger movements rapid, and obviously the market's music going up doubling in a year is something you haven't seen in silver, as until the final phase of the earlier bull market that went from basically 1970 to 1980 in gold, and I would argue from 1966 music, or 65 to 1980 silver, because silver was basically demonetized out of circulation. So the final phase is when you get the panic manic phase at music, the very top. We're not there yet. We need to see the public come back, but when they do, it'll be unfortunately from music history. It'll be more on fear than greed. It'll be fear that the dollar is losing value. Fear that I don't have enough for retirement. Music fear that my pension plan won't be there. Fear that my IRA is going to be taxed beyond what they originally said. I mean, there's music, all kinds of things I can make up. Some of them legitimate, some may be out in the weeds. Nonetheless, point being that fear drives a market harder than any other emotion, and I don't like to see it, but I do know the market's music, and I do believe that's what we're going to see within the next couple of years. Many people say, well, the silver deficit that we've talked about will guarantee. Well, they music have used the word suggest strongly, and we have a 10-year bull market on fundamentals. I agree with them totally, but being a student of the market since I was a 16-year-old kid, I'm well past that now. We're in the acceleration music phase, and it doesn't lie. We get a big movement in a short amount of time, and this is what we've already. What's the catalyst? What's the trigger for that big music surge? It's fear. It's that people think that the currency is going to become music worthless. As we debase, a currency becomes worth less, and it's worth less. It's worth less, and then there's fear it's worthless. And when you hit that psychology, the real move in inflation, people base it on, how much money has been created, and that's part of it. I mean, as a strict Austrian, that's the exact definition. But the true meaning is the psychological factor that cannot be overcome. When 1%, 2%, It doesn't take a huge percentage of the population believes that their currency is going to fail, and I've got to buy something of value to maintain my purchasing power. When that moves into the US dollar, and it has, but not to a big degree yet, when that takes place, you really can't undo that psychology, and that's when the run to gold really starts music. And the old adage, there's no fever like gold fever, is very true when people run on fear, and they think that the only thing that they can do to music protect themselves is to own something that doesn't have a counterparty risk, is known to be of value for thousands of years, and something they can believe in and actually assuage music, some of that fear, you will see a move into the precious metals. We've probably never witnessed before because we now have the internet, instant communication, and easy access over the web. Purchase precious metals that didn't exist in music. The question everyone asks at this stage is always the same: what triggers the final move, lights the fuse, what event, series of events causes silver to transition from a tightening market to a music runaway one? If you had asked me this 20 years ago, I might have given you a list of geopolitical flashpoints, music monetary policy errors, bank failures, or structural breaks in the credit markets. And all those things can still act as catalysts. But we're in a very different phase today. We're in the acceleration phase of a secular bull market where the psychology is already primed. That means the trigger doesn't need to be large. It doesn't need to be dramatic. It doesn't need to be 2008 or Lehman Music Brothers or a sovereign default. It can be small, something the market would have ignored in 2005 or 2012, because when a system is already under strain, even a minor shock can create a cascading response. A cooling system failing at a Chicago exchange, for example, shouldn't cause global financial commentary, yet it did. And because the market already knows the system is fragile, music, the moment a data center goes offline, the speculation starts. Was this deliberate? Was the metal about to get squeezed? Were shorts trapped? Is this the beginning of a delivery default? The event itself, music, wasn't the cause. It was the belief that the system might not be able to withstand stress. That's what happens in late-stage bull markets. The psychology becomes the accelerant. Fear is the primary driver, not greed. Greed drives the middle of a bull market. Fear drives the end, and the fear isn't about missing out. It's about being left with nothing. Fear that the currency is losing purchasing power faster than wages can keep up. Fear that savings accumulated over decades won't buy what they used to. Fear that pensions, IAs, and annuities will be debased in real terms, even if they rise nominally. Fear that political leadership, fiscal responsibility, and monetary stability are all degrading simultaneously. It only takes 1 to 2% of the population to internalize that fear music for the psychology to shift. Once that happens, no chart pattern, no interest rate move, and no government reassurance can stop the momentum because the fear isn't rational, it's instinctual. That's the point where money starts moving into precious metals, not because gold or silver is going up, but because people begin to suspect that everything else is going down, and that's why price action becomes vertical. Look at 1978 to 1980. Silver moved from the mid-$4 range to nearly $50 in less than 24 months. That wasn't because mine supply collapsed. It wasn't because industrial demand doubled. It wasn't because retail coin buyers suddenly became geniuses. It was because the psychology shifted. Inflation hit levels people didn't music think possible. Trust in government statistics evaporated, and suddenly everyone wanted what they thought others would soon want. Real money. The old saying, there's no fever like gold fever, applies even more to silver because silver is the most undervalued monetary metal when compared to gold. Silver is the emotional metal, the people's metal, the metal the public buys when they feel the system is slipping away from them. But we haven't seen the public yet. Music retail demand has been quiet. Dealers are buying back more than they're selling. That means everything happening now, all the volatility, all the arbitrage, all the supply strain, is happening without the one group that historically pushes silver into mania. Imagine what happens when they arrive. Imagine what happens when the public wakes up and realizes supply is already tight before they even entered the market. Now add to that the long-term structural deficit. For 4 to 6 consecutive years, silver demand has exceeded mine supply. The Silver Institute acknowledges this, though they often soften the blow by categorizing investment silver as a balancing item. But the underlying reality is this: stockpiles are being drained. Music China was the wild card for years, occasionally distorting in order to stabilize global supply. Music keep prices lower and ensure its domestic manufacturers, especially solar panel producers, had access to affordable metal. But that era is over. China has now stopped supplying the West, banned silver exports starting January 1st, and is signaling that silver is a strategic resource. China does not ban exports to be polite. When China bans exports, it is declaring something about its internal needs. This is the same China that consumed more silver for industrial use than any other nation, that is dominating the solar industry, and that has ambitions to lead global manufacturing in nearly every high V-value sector. And now they are stockpiling silver, not distributing it. If that doesn't get your attention, little will. And remember, music governments do not buy silver for speculation. They buy it for survival. When nation-states step into the market, they do so not because they think the price will rise, but because they think they will need the metal later, and they fear they won't be able to get it. That's when a commodity transitions from a market asset to a national asset. We saw the same progression with rare earths, cobalt, lithium, and palladium. But silver is more essential than all of those combined because it is both industrial and monetary. A dual identity metal is the most dangerous for a strained market because demand comes from two completely different sources that rarely peak at the same time until now. We are rapidly approaching the point where monetary and industrial demand collide. When that happens, you don't get an orderly repricing, you get a dislocation. Now, think about the derivatives market. The entire pricing system for silver and gold has been built on fractional reserve principles. As long as only a tiny fraction of participants stand for delivery, the system works. But once delivery demand rises, the system's leverage becomes an Achilles heel. Tokenized gold and silver threaten that system further. Not because blockchain is magical, it's not, but because tokenization allows an investor to demand fully allocated metal, not paper promises. The LBMA and comics have survived for decades because most people never asked for the metal. Tokenization changes that. Now even a retail investor can demand delivery or transfer of allocated metal instantly. If enough people move from unallocated to allocated systems, the paper market will face its first true stress test in modern history. And if that happens during a period of rising industrial demand, rising geopolitical tension, declining trust in fiat, and weakening fiscal stability, you have the ingredients for a runaway move, not because people want silver, but because people no longer trust alternatives. Let's talk psychology again, because this is where the rubber meets the road. When the public begins to fear that dollars are becoming worth less and then worthless, the psychology shifts from preserving wealth to escaping risk. People won't buy silver because they want to make money. Music, they'll buy silver because they don't want to lose purchasing power. Every hyperinflation in history, music, Weimar, Germany, Zimbabwe, Argentina followed the same psychological pattern. The currency devalues slowly then suddenly. Music, and it's the suddenly part that catches everyone off guard. But here's what most analysts forget. You do not need hyperinflation for silver to explode. You only need fear of hyperinflation. Fear moves more money than fact. Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news, unavailable to the general public. Join our free gold and silver newsletter today.